It is the lowest business confidence that we have recorded on record, and it's really many things conspiring now. There are some quite fundamental challenges in the Chinese model now. But we have also come to a point now where maybe that model has run its course. You know, it used to be that black swan events, they were happening maybe only once a decade or twice a decade, and now you have the new situation in the White House. It's one after the other.
The trade war between the U.S. and China is further clouding the outlook for European businesses in China. Well, that's the message of a new flash survey of European companies released today. Jens Eskelund is president of the European Union Chamber of Commerce in China, which conducted that survey, and he joins me for more. Jens, thanks for joining us. Before we get into the details of this survey, maybe you can summarize for us as briefly as possible what is the most important finding?
I think really that there are three main takeaway points here. One is that European companies are better prepared this time around than they were during Trump 1. When the first trade war came in 2018, we've been through a number of black swan events since, and European companies have adapted. The second one is that our companies feel that the Chinese tariffs imposed are equally harmful, or perhaps even more so than the US tariffs being imposed. And the last one is that, already there was a fairly pessimistic outlook on profitability and growth in China, and that has become even worse today after all we have seen here over the past 2-3 weeks, months.
Okay, great. We want to touch on those points in just a moment. Let's first explain this survey and what it is. This is a survey that ran between April 17th and 27th. That is after the U.S. and China both announced their relative tariffs and counter tariffs that remain in place. And it is after the U.S. put in place that 90-day suspension for reciprocal tariffs on other countries. China is not part of that suspension. Now, for this survey, there were 162 responses from companies of various sizes, just over half with less than 250 employees, about a third with more than 1,000 employees, and the remaining odd 20% with a size of between 250 to 1,000 employees. And we should add the most represented single branch was machinery, but that was with just 12% of all respondents. So a lot of branches reflected here. Jens, you touched on the 3 points that stand out to you. One thing that stands out to me, if it was a single number, is business confidence. 60% of respondents saying that business has become more difficult since the beginning of the year. It was already difficult, wasn't it?
Yes, and it is the lowest business confidence that we have recorded on record, and it's really many things conspiring now. Before we had the tariff situation, by far the biggest concern of European businesses, it was actually the same concern as Chinese businesses, and that was the state of the domestic Chinese economy. Consumption is simply not growing, and we have overcapacity. Now, on top of that whole situation with overcapacity and lack of consumption growth, we now had the tariffs. And if anything, if you're not able to sell your products in the United States anymore, that just adds to the overcapacity situation. So the mood is a bit gloomy now, truth be told.
You began by saying that companies were better prepared this go around based on what happened with the first Trump administration. And what we can see in this survey is that more businesses seem to be directly affected because they're importing inputs from the U.S. for their production instead of producing for the American market. Is that what you mean by that better preparation? What does it tell us about how European companies have changed their business approach in China?
It used to be that black swan events, they were happening maybe only once a decade or twice a decade. That's the reason they're calling black swan events. But if you go back in time, the past 7 years, first in 2018, you had Trump 1. Then in 2020, you have COVID. Then you had Russia's war in Ukraine 2022. Then you had the Red Sea crisis, December 2023. And now you have the new situation in the White House. It's one after the other. Companies now understand that there needs to be a premium on supply chain resilience, not just in time efficiency. And they have adapted. So right now, I think they're more agile, they're more adaptable, but still it's hurting. Now, the interesting thing that we are seeing here is that a lot of European companies that produce for the American market, that they have been able to de-risk themselves and maybe produce in other locations. So it's not as many companies as we originally thought that would be impacted because of the US tariffs on Chinese exports. A lot of European companies, not all, but many European companies have found ways around that. The problem is the other way around, but that's not finished goods. That is, as you said, it's components. It is, for example, specialty chemicals that is maybe perhaps only produced one place in the world in the United States. It could be specific components for machinery or software or something else that you can only find in the United States. And what we see here is that in production sometimes, no chain is stronger than the weakest link. And that's the reason that you can have this situation where even though maybe it's just a small component, it might be enough that it can actually have a significant impact on your manufacturing here in China.
Does that mean that this latest round of tariffs and counter tariffs is essentially reinforcing this idea among many European businesses of ring fencing their Chinese operations, China for China? That means supply lines as much as possible within China and then also producing for the Chinese market.
You're absolutely right. And that's a development that we have seen for a while now, that, a number of companies have chosen to offshore parts of their manufacturing to outside of China to protect their global supply chain. But we've also seen the opposite, that a lot of companies have chosen to increase their onshoring in China. But we're actually seeing, in tandem with this, an opposite dynamic also. And that is because domestic consumption in China is doing so poorly, a lot of companies are being forced to increase their exports. So it's really a mixed picture that we are seeing right now. So yes, onshoring in China for China to protect your China supply chain, but also in order to boost your profitability, exploring market outside of China.
Those with U.S. inputs, roughly half of them say they're going to change suppliers. Some, as you mentioned, may not be able to. They'll have to raise prices potentially. How difficult an environment is this in China when it comes to prices and competition? I imagine there's a lot of pressure to keep prices either the same or even lower them in such an environment for many of these businesses.
Yeah. The main issue our members are telling us is that we have now had a situation where we have had 30 consecutive months of producer price deflation. Every month you see that the prices that you can command for your products is declining, and that is eroding profitability. We see underutilized assets. We see growing inventories. So by far the best thing that China can do right now, that is to get consumption working again. That will take away a lot of pressure from our members. But in addition to that, China needs to make sure that there is a balance between manufacturing output and consumption, because there is still actually growth in consumption in China. The problem is just that we have had a year and a half now where manufacturing output has been growing faster than what the domestic market can absorb, and that is what is driving deflation, driving the need to export, and why it's so hard for Chinese and foreign businesses in China right now.
Jens, we see in this survey, when you ask businesses to describe the outlook for your industry over the next 2 years in China, we see pessimistic is a response for almost 60% of companies by the area of profitability, and 64% are pessimistic when it comes to competition, competitive pressure. You talk about the need to raise demand within China. That's something that even Beijing likes to say, that there is that option of raising demand. But a lot of experts say that's not so easy, actually, that it requires fundamental reforms that are going to be very destabilizing for the regime in China. Is it just a matter of sort of turning a dial up, or is it something that's more fundamentally difficult in that market?
I think that there are some quite fundamental challenges in the Chinese model now. I mean, the Chinese model, manufacturing-based, export-driven, has in many ways worked fantastically well for China and created enormous wealth. But we have also come to a point now where maybe that model has run its course. And what we see in China is that consumption in proportion to GDP is much lower than what we see in other comparable countries. We also see investment levels that continue to be much higher than they are. And we continue to see investments going into unproductive forms of manufacturing to produce more goods for which there is no real market. A lot of it is driven by anxiety. The money is there in the population, but people are not spending. And they're not spending because they're nervous about their economic future. Now, 70% of the Chinese people's savings are in real estate. And real estate has been dropping dramatically over the past few years. So Chinese people need to feel comfortable about their economic future again. Then maybe they'll start spending. And that's what we think needs to happen. That is, some of all that capital resources that have been allocated towards investment in infrastructure, which may not be needed as much needed as before, and into manufacturing, for which there's perhaps is no need either, maybe you should consider to reallocate that to parts of the economy where you sort of can reduce the need for people feel to have this high level of precautionary savings. That maybe could help to spur change sentiment so people begin to spend and consumption can grow more sustainable, while at the same time you don't overinvest in manufacturing. But it will not be easy.
We know that beyond tariffs, just tariffs as a tool that the Trump administration uses, it's also complained very loudly about just the fact that there is such heavy European investment in China, historically over the past few decades, but continued today. There is obviously a lot of disagreement within the political levels within Europe about the amount of European investment in China. Are there concerns growing among European businesses that pressure is also rising, that it's going to rise even more as Washington continues for the next 4 years to beat this drum of, Europe should not be as into China as it can be, that the European businesses are going to essentially be split between these sides?
Truth be told, European investment is not all that massive. I think in 2023, the EU 27 countries were investing the same amount in China as they did in the state of Texas. So I think sometimes we need to put it into perspective. Considering that China is the world's second largest economy, it is actually not an enormous amount of money that is being invested. And I think it says something about that maybe China should look at the conditions being offered to foreign companies in order to be able to attract more in investment. And I think what we have seen actually over the past years is that except for a few very large companies have actually become more risk averse. They recognize that it's a more complex geopolitical environment, and maybe instead of investing directly into China, maybe they prefer to take long leases instead of making investments. Maybe they have long-term off-take agreements. These kind of things that reduces your need to invest capital in China and finding other ways to be active in the market. And we think that's going to continue that trend. But I think we should be clear-eyed about when you look at sort of total investment levels, they are not very big. In fact, most of the investments made by EU 27 are a handful, 10 or so very large European companies, and most of them are German.
Yeah, be that as it may, this is obviously a target for Trump. And we know that also within governments in Europe, it's also become a point of debate. Do you expect, nonetheless, investment levels and investment rules, I should say, that there will be tighter investment rules coming in the years ahead? Is that something that European companies are expecting?
We are, of course, looking very careful at regulation and whatever restrictions there might be on both inbound and outbound investment. Other things equal is not something that we are fans of, and we think that governments need to be very, very careful when they put these sort of barriers in place of investment. But I think also, let's be realistic. And what have we seen? We saw the investment screening mechanism being introduced 4 or 5 years ago, and we have seen it has been very, very few deals that have actually been stopped on that. And I would imagine when it comes to outbound investment, it would possibly be even less. So again, we encourage government to go easy on that, be cautious, and not creating more barriers for business. But what we have seen in reality, with what we already have in place with inbound investment screening in the European Union, it has not been that dramatic and has not had a dramatic impact on the way that companies operate.
Maybe we can wrap up with a sort of a summary here. Jens, what are we seeing when we look at European business presence in China? Are companies being squeezed out? Are there fewer companies investing? It's an incredibly important market for some bigger companies. How would you describe the shift that we're seeing right now?
I think that European companies in general are incredibly committed to China. We have 1,700 member companies in the EU Chamber of Commerce today. We expect that it'll be roughly the same number 5 years from now. We don't see, however, large numbers of new companies coming into China. And what we see structurally is that it appears, and in particular, the small and medium-sized companies, and for example, also some companies in the German Mittelstand, that they are being challenged a bit now on the Chinese market. So, China is complex, and if we are moving to sort of a bifurcated world that have sort of separate tech ecosystems, then for many small and medium-sized companies, which are the backbone of the European companies, they simply may not have the bandwidth in terms of human capital, in terms of technology, in terms of capital, to manage separate supply chains, completely separate supply chains on several continents. That may simply be too much an effort to put into that. So we think it will be difficult. We do, however, also think that China still will continue to provide opportunities for European companies, in particular those that already are in China.
All right, before I let you go, I have to ask you about these planned talks between China and the U.S. in Switzerland coming up this weekend. Those are obviously driving markets to be a little bit more optimistic. How would you look at that? Is there reason to be optimistic, to be hopeful?
Listen, we're just happy that the two sides are talking. For all we know, there's been very little engagement between the two sides until now, and that has frankly been our main worry, that there seems to be very, very little contact. If the two sides are beginning to talk now, I think we should all be happy. And hopefully they will work something out that works for everyone. I mean, even though US, China, strictly speaking, is not directly about Europe, it is something, as I think our survey demonstrates, that also creates enormous uncertainty for European business. We want stability, we want predictability, we want a clear line of sight. And most of all, we want the two sides to be able to sit down and have a grown-up conversations about some of their differences.
All right, that's Jens Eskelund. He's president of the European Union Chamber of Commerce in China. Jens, thank you very much.